All right, traders, good morning. Can you all hear me? I just want to double check and make sure. I had a little bit of an issue with my microphone earlier today. Can everybody hear me okay? Testing,
Loud
test
and
one.
clear, Blake. Loud and clear. Good
Hey,
morning.
good morning. Good morning, K-Man. How you doing today?
Yeah, I'm good, Ben. Yourself?
I've been up for a while today, man. Just I'm doing okay. I'm on my like 14th cup of coffee. It's all good.
Uh-huh. Yeah, it's
So,
all right.
what's that?
That's all right. It's usually the 20th where you get a headache.
Right, exactly. I am feeling maybe a little dehydrated at the moment, but that's okay. I'll check in with you here in just a second. I just want to make sure I the microphone was working okay, so it sounds good. So yeah, hey, this morning, markets are under a little bit of pressure. Actually, we just had earnings from Walmart. I don't know if you guys have seen it. Walmart's coming under a little pressure, and Walmart is one of those stocks that we do have to pay a little bit of attention to just because of the consumer aspect of things. It is obviously a stock that has been just on fire as of lately, and is coming off a little bit pre-market. So as consumers cool a little bit, it's not so much the part of the K-shaped economy that the market really cares about, at least for not right now. But it is something we should be noting for right now. That we are seeing Walmart come under a little bit of pressure. I don't think it's had any impact really on other retailers. You can look at Amazon. Amazon came down after earnings a couple weeks ago, but not really, just kind of been consolidating. But yeah, I just wanted to make mention of that because if you saw futures come off just a little bit a few moments ago, that is probably the reason why when Walmart earnings did come out. Now we do have weekly unemployment claims today, but what we are seeing, and this is something I want to take note of this. Let's go to like this is the general chat room. There's a comment that Mark from had said earlier. Let me go ahead and find it really quick. Uh, where is it? And it's something he's been noting all week, and it's something that I
Oh,
think is fairly
yeah.
important. I guess I got to go up.
But
There's so many comments. Oh,
I
that's
can
not there.
I can
Oh,
repeat
there we
it.
go.
It's just that yeah, exactly. I mean, US has been buying dollars virtually every day the past week when
They
as the
have
market.
been.
Yeah.
Yeah, like as soon as American traders come in, they just start buying the dollar. It's like you see this failure in the euro, for example. The euro is a good example, but I mean you can look at it as the Aussie. You can look at it at sterling. You see this failure that Europe has on selling dollars. Then Americans just come in and they just start buying dollars like as soon as they step in. They've done it every day this week. What do you make of that, K-Man?
There's an interesting note as well, but we probably shouldn't show it because it's should be staying in our room. But
Yeah.
and I've been thinking about it too, when and speaking about it in vague terms over the shows. It does seem like there is a program ongoing, and it looks to me like, I mean, people have been trading that Sell America trade. And it does seem to me like for the past, even when I was off and I started to note that in the euro dollar, lower highs, a bit lower lows, it seems like a program ongoing of perhaps unwinding some of that trade. We can see it over most of the currencies actually. Maybe somebody is just buying back a bit of that trade, and that would make sense even if you look at across the spectrum. Dollar a bit higher, bonds a bit doing better because people have been selling bonds, and then equity markets holding up despite whatever risk that may hit the markets and results dragging companies down left, right, and center. And yet, equity markets haven't really fallen out of bed. And it may hint that some program is ongoing to maybe let some of that, or buy back some of that South America trade also. But it's really notable that, and yesterday was a prime example again. As soon as you guys walk in, somebody is going to sit on the bid in the dollar, and a program would be the typical. For instance, if you take one big account, usually they're done by really big money managers. And I'm going just to give the example of the euro dollar. When you come in, you go and sit on the offer at 118 the figure. And once the demand dries out, you go and sit on the offer at 117.90, and then you go and sit on the offer at 117.80. But you don't hit the market hard. You just that's the program. You just go and sit on the offers until nobody pays you out anymore, and then you adjust. So it's been notable, and I've been also talking about that in on the shows about those lower highs, lower lows in euro dollar cables. Same thing. Even the dollar yen yesterday and the day before, and yeah, you see it in all kinds of currencies.
Yeah, and one of the things is, as you mentioned a little bit earlier, and I want to reference it as well. Look at yields. I mean, this is a big consolidation in the 10-year, and I know I shouldn't do technical analysis on yields, so F it. We'll just go over to the 10-year notes, and you'll see it is a very similar look. You're seeing 10-year notes come off. That means yields are rising. Dollar gets a little bit of a tailwind as a result. We're seeing dollar buying coming in every North American session. Now, one of the things that could be driving this, and this is the question that maybe you and I can address here, and I'll also ask Dale Briscoe a little bit later when he comes in, how he's managing all this. But we have this U.S.-Iranian conflict that really is, it's kind of intensified over the last couple of days. And you start to see, we got a big naval force over there. People are speculating that something might happen over the weekend, which, by the way, everybody, is not good news, just so we're clear. But the dollar maybe is getting a little bit of a tailwind, with that as well. How do you feel about international geopolitical conflicts like this, even though they're not close to home? How are you going to navigate this, K-Man?
I'm especially interested to see what's going to happen, well, in the short term, with that build up in the U.S. naval presence in the Middle East. That should create some more stress, I guess, into the weekend. Nobody will want to be short um, oil. No real short-term traders will want to be long risk, I guess. So yeah, there's a bit of risk going on, and per correlation, I would say dollar is doing a little bit better. Um, what I would be careful about is maybe also, if you look at metals, there may be a late spike tomorrow in gold, for instance, because that's been actually relative wobbly and volatile as it is, but it's not been trading that big of a risk off right now, right? It's very stable.
Yeah.
But I think maybe tomorrow, last day of the week, there could be a bit of any animation going on in gold as well, because there's always going to be that weekend risk.
Yeah, and yeah, so I think you're right. I mean, you look at crude oil. Crude oil is getting. I do want to just go ahead and point out, and this has been a big deal for me, and we'll go look at Brent here in a second. Crude oil has respected this 200 DMA. Literally, I mean, even probes below it a week and a half ago found buyers, and you can see this. I've been telling our traders, as long as we're above the 61.20 level, there's no reason to be on the short side. But it's really holding up now, and with risk intensifying here, could that continue this move higher in crude oil near term? And I think that is the risk. I mean, we break above some of this resistance here. That's a 50% retracement. We should be trading closer to $70 if something does indeed happen over the weekend. Obviously, come Monday and nothing happens, you might be able to squeeze off an intraday short in crude or something, just to
Mhm.
trade out of a little bit. But yeah, you can see Brent is actually making a little bit of a lift here. Crude oil does look like the predominant recipient of what's happening. In currencies it's not as clear.
Yeah.
Well,
Just
I
note
was just gonna
on Brent, there's been a couple of options, $100 being traded this morning.
Yeah, I
So
saw
I
that
mean,
too. Yeah.
the doomers are out in force.
Yeah, so we got the dollar that's pushing up against the 618, and you guys can see this Gartley pattern that's pretty clear in my view, which I mean that makes sense. I mean if you just extrapolate this a little bit and think about where it goes, we're probing this trend line here on any breakout in the dollar. The dollar could respect this. Now, is the dollar a risk off type of currency to
Oh,
you?
oh, Blake, we've been changing correlations so often. I think for the time being, it is a risk of the risk of correlation is there in parts. But it's not clearly that's what I call those coincidence correlations, and I've been talking about it because the question was asked this morning for a different type of instrument on the flow show. It's like those coincident correlations. I rather think that is something different going on right now, but it is for sure part of the game because we've seen when stocks came down, dollar was beat. There's a bit of risk ongoing right now. Dollar is also bid, but then typical risk pairs. Maybe now we can talk about emerging markets, which started to move yesterday. That there's a bit of risk ongoing as well. But I really think it's kind of a that dollar all of a sudden finding legs of its own and people maybe getting out of some positions, you know. But yeah, I wouldn't completely dismiss it. The dollar side of things right now. It's been of old, right? When there is heightened geopolitical tension, the dollar usually picks up a little bit of a bit.
Yeah, and I want to. I'm going to highlight something in the currency market that I think everybody should be looking at. Not very many people trade this. I think, K-Man, you and I might be the only two people I know that actually trade the rand. But I think it's worth noting, guys. This is something that
Mm.
you may not trade currencies, which is fine. I don't care if you do. I love the currency market more than any other market personally, me personally. But this is something that even if you don't trade currencies, if you trade strictly equities, you trade options, you trade commodities, you should be paying attention to like some of these emerging market currencies because they can tell you a lot. But I want to show you something technically, and I talked about this in the chat room today. And again, if you guys are not in the in our chat room, this is where this is the kind of conversation that I think is really important that you guys see, and you can see why we're talking about this. This is the US dollar South African rand. I want to go longer term here and go over to a weekly chart and just show you how nicely we are pivoting off of this weekly channel support. So not only do we have a lot of technical support here, you zoom in a little bit and you're like, oh shoot, we have a triangle forming right off of this channel support. Yeah, it's really important because the dollar rand is showing its teeth this morning. So if the dollar rand really starts to break out to the upside, that's going to be something that I'll be looking at as K-Man just said. It might be a coincidence correlation, but in emerging markets, it's not so much a coincidence. This is where it becomes an actual carry trade. I mean, where's the South African Reserve Bank at as far as interest rates go? K-Man.
They left them unchanged, right?
I'm
Now
trying to
you're
think of what
asking
the
me a question.
percentage where they're at right now. I'd have to go back and look, but it's high. I mean, it's
They're at six. What is it? Six and a half, six three quarters. What are they at? Let me just look it up while you're cheating
Yeah,
exactly.
he'll look it up. He's going to look it up while I talk about it. But these are these between
Six and
Banxico
6 3/4.
6 3/4. So these are the types of currencies that have been beneficiaries of a big rally. I mean, you look at and thank you very much, K-Man. You look at the S&P here, and you can see, oh well, the S&P has gone up. The South African rand has strengthened, right? And so as we start to see that reversal develop, that's the currency market, the undercurrent, if you will, of what you see on the surface of all the markets. You're seeing the emerging market currency come under a little bit of pressure. And as that happens, if we start to see this peak up and you start to see, the dollar rand break to the upside, that would suggest that we are at high risk of breaking lower in the S&P. So those are the things that if you are not a currency trader, again, I don't care if you are or aren't, but these are the types of things that we look at to give us a heads up on what might be happening in the S&P. Speaking of the S&P, I'll go back and reference this just because we we pretty much talk about this on a daily basis. What a frustrating market this is. When you're talking about the SPOOs. Now we just hit the 618 yesterday. You can see that this is the resistance zone that we drew out early morning yesterday. If you guys are part of our community, I go through this bias chart every day, and you can see the S&P 6,900 to 6,980. So 6,900 was resistance right here. Was the bottom of this zone, which comes in right there. And then, I highlighted it up to the 618, but we don't write those numbers so close because it's 15 points apart. 15 points is not too big of a deal. 6980 would be the top of this triangle. So our first level resistance is into the resistance zone. Then we have a triangle. So we basically ran into that resistance zone, previous support, acted as current resistance, 618, triple confluence there, really stopped us. That doesn't mean that the S&P is done here and we're going straight down. But what that does mean is we're stuck in this freaking very annoying range. But you had companies like Walmart that came out, missed earnings. It's going to weigh on sentiment. Everything that's happening in, the U.S.-Iranian conflict, whether or not you think that that's going to be a big deal, markets tend to shoot first, ask questions later. In other words, you'll get traders that say, I don't even want to deal with it. I'd just like to get out of my positions and get back into cash, and then I can revisit it later if I want to. And so you'll get that shoot first, ask questions later type of response when there's geopolitical risks like this. If something happens over the weekend and we remove a few Iranian officials and it seems like it's more of a regime change, you're probably going to see whatever equity market selling we see, you're going to see it reverse going into next week. So, and it'll continue to be frustrating. But I don't know what's going to really dislodge us out of here, K-Man. I've been scratching my head for the last couple months, wondering what is going to move us out of this very tight range at the upper end of this longer term channel. What do you think? I mean, you got equities that are just poised up at these highs, at channel resistance. What do you think is going to dislodge us? You have any ideas here?
Main catalyst upside is geopolitics, I think, resolved. Main catalyst to the downside is a markedly weakening job market. Before the job market collapses, I got the impression that people holding equities are not going to get too panicked. But if the job market really rolls over, then I think it's going to be panic stations.
Yeah, and I'm gonna come back and revisit that question with Dale Briscoe. We're gonna be bringing him on in a little bit. As he manages. He's a fund of funds, I believe, and he manages a few different funds. I'll see how he's navigating through equities because it is very annoying. And I agree with you. I think the jobs market's going to be really key. I think that interest rate expectations are going to also be critical once if Kevin Warsh ends up being the Fed chair. And I say if because there's still a lot of resistance there with the overhang that you have with the Trump administration and Powell, and Kevin Warsh being able to even be voted in to take the chair position. Because if he's not, then you have internal elections, an internal assignment from one of the current Fed governors, which would be really interesting to see how that all plays out. But I think that's an interesting thing with equities. Also, I want to point out that this earnings season's been different than most in recent months. What we've seen is companies that report earnings, and you're seeing the initial response being good, but then you see stocks falling after they report earnings. And that, usually when stocks start coming down on good news, that's something you got to be a little bit more careful with. So I've been noting that from several different companies this earnings season. I think it's a departure from what we've seen in recent earnings seasons in years past. It's just worth noting. Let's talk a little bit also, K-Man, about the yen. And I know this one's near and dear to your heart. We've had the all these yen pairs. You've seen them give us some pretty big reversals overnight. Like the Aussie yen at the 618, the Kiwi yen from, I would say, horizontal resistance. You can see it. Just let me just. And by the way, we did have Australian jobs data that came out, which they weren't horrible. Unemployment rates, didn't tick up, so that's not bad. But yeah, you can see these yen pairs really have turned. Is that a result of the yen being a risk-off currency? I mean, I've always wondered when or if the yen would start to be bought should we see risk aversion. And let's also agree here, K-Man, that we haven't seen risk aversion. We don't even know what the hell it looks like nowadays. I mean, let's be frank, right?
Yeah,
So,
absolutely.
okay.
It's been extremely uneven, and the issue with the yen is that since we can actually go back since Ueda took the helm of the Bank of Japan, but more pronounced since Takaichi came up onto the political scene. Yen has been a very bad risk proxy. It's been trading in its own world. We do see the occasional correlation, but it's still a very, very bad risk proxy. I'd rather, and it's also from a distance, but I'd rather trade stuff like Aussie, maybe EM again right now, than really trading yen, because we are trading fiscal policy in Japan, and we are trading potential rate hikes of the Bank of Japan. We are trading, if the dollar yen rallies, potential for interventions, but it's been a very bad risk proxy, and I'm still not on board to start trading it again. When I think it could be back in force is when we will know what Takaichi will do. We will know the first effects that it may have on the economy in Japan. And once that is settled down and the market gets comfortable with that, then perhaps the yen will start to get back into more of a risk on, risk off instrument. But for now, it's still extremely fragile. Now,
So,
what happened
oh,
this morning? Yeah.
I was going to ask one of the most sensitive risk currencies that, like, if you ask anybody over the last 20 years, right, that knows a little bit about FX, probably enough to be dangerous, but maybe doesn't really focus on the market at all. And you ask them, oh, okay, well, what's the highest correlation between the S&P and a currency trade? Most of them would probably answer the Aussie yen, right? I mean, that's going to be, again, that's like the FX tourist kind of answer. So somebody that doesn't really know about FX, but they know about FX, they'll go, oh yeah, well, if you match up the Aussie yen with the S&P, you're going to get a pretty strong correlation. Do you So you don't think that the Oz yen would react too much to risk off?
The Aussie side will. And that's what I've been saying for a couple of days in since I'm back in back from the trip, and I've been noticing that over the past maybe week and a half, 2 weeks, is that
Hmm.
Aussie yen will maybe react because of the Aussie side, but less because of the yen side. But if you do the overlay of with the S&P, it's going to show the same direction, but that is for a different somewhere reason because the yen has been weakening, well, maybe partially because of risk on also, but especially because Takaichi is expected to spend tons of money, and which waters down a currency. So, okay, we can actually see that the yen has weakened more rapidly than the S&P has strengthened. So that's where the fiscal thing comes into play. But okay, never say never, obviously. But no, I just wanted to come back on what you said earlier, and I've been looking at that on the Flow Show as well. Is I think there's a bit of psychological effect as well playing in the yen crosses today. Is that we moved over 155 in dollar yen, and there is that little risk that officials may not like it. And
Yeah,
also,
but everybody talks that no one that or the Ministry of Finance or the
mm,
BOJ, they're not going to do anything until we get to 160. So why is 155 important to you?
just psychologically, and at the
Okay.
same time is at the same time, yeah, we saw all yen crosses recover towards certain levels, and that's been it's been weighing on the dollar yen this morning. If you look at euro yen, is a big figure of its highs. Aussie yen is what is it, like 60, 70 points of its highs, and you can overlay all yen crosses, they're all lower. And I think so that's the bit of a global, I don't know, take profit, or those who have missed the first boat trying to jump on it right now and selling some yen crosses. But it's been a theme this morning.
Well, you know what? Instead of being super smart like K-Man,
I'm not.
I'm gonna give you guys something else to really think about. Forget all the yen crosses, forget them all. If you think the stock market's going down, well, then just sell Bitcoin. That's all I have to say. Just go sell Bitcoin. Look at look at Bitcoin right now. I mean, it looks so weak, and I'm obviously joking a little bit here. Came in and I actually hit the wrong button, so let me remove that really quick. But man, take a look at how Bitcoin is just responding and how poor it looks. I mean, this is obviously the S&P longer term. This is a daily chart. You can see very, very strong correlations and risk. Then we've seen this massive divergence between what has happened and obviously what the decoupling, right, between the S&P that's here and Bitcoin that's here. I mean, what happens if the S&P comes down? What happens to Bitcoin and this risk proxy that up until the end of last year, what is that? Maybe about October or November, up until then was such a strong correlation. What happens here? I mean, if the S&P comes down, does Bitcoin go to zero? What do you think?
I'm 30 bucks bid.
Oh, your bid's still out at 30?
My bid is
Uh,
still in, mate. I can show you my Coinbase account.
no, you know what?
No, but
I'm
I think you're right, Blake. But I think something more important may be happening is that if Trump and allies lose the midterms, then Bitcoin is probably going to trade 30, 40K. We have data in about 30, 40 seconds, by the way.
Oh shoot, I forgot about that. You're right. You're right, K-Man. That's something that I think hodlers should be paying attention to. All right, let's go to the weekly unemployment claims. Let me pull over the. I'll just pull up
Mm.
yields really quick. How much time do we have? Thanks for the
20
reminder.
seconds.
Uh,
20 seconds.
20 seconds. Okay, so
You're
yeah,
going to be late. You
we're
are
just
going
gonna
to
we're just gonna see what the S&P does. And we have trade balance data, but I'm really focused on the weekly unemployment claims and the initial jobless claims right here. Oh, do we have Philly Fed too? All right, here we go.
Yeah. Oh, trade a
In
little wider
line,
again. Fed, Fed, pretty good.
better than
No
expected down
dramas in
there.
the claims. Claims a bit lower. What else? Business conditions, Fed, Fed, really good. Where's the employment index? Employment is a bit lower though, goes slightly negative. What do we see? What do we see? Not a lot actually. We don't see masses going on. Um,
The S&P just kind of spiked down to its lows. Hey,
Prices
while you're
coming
giving
off
some
quite a bit.
analysis, I'm gonna go grab Dale Briscoe.
Yeah,
So go ahead and comment away.
chit chat. Yeah.
Yeah.
Yeah, just put on. Yeah, you can leave it on the S&P. The rest is not moving too much. The dollar actually is picking up a little bit. I think it's on the back of the claims. Pretty decent overall. Fed manufacturing index coming in at 16.3 versus 7.5 expected. But as I said, the employment index is not looking great because it dips into negative territory. What do we have on the? I haven't seen the imports and exports balance for the US trade balance, but the preliminary is a trade balance is the deficit is wider again. Just looking through the Philly Fed prices lower and capex a bit lower than last time as well. I wouldn't think that this warrants a big move. Couple of ticks in the euro. Where's the S&P? Is it doing anything?
No, I mean
Nah,
we brushed new lows,
ticks,
but
ticks,
yeah.
ticks. Yeah, ticks. Nothing really to write home about. I think the biggest.
Dow futures are, they're at their lows of the session right now,
Yeah,
but that's more to do with Walmart at the
yeah.
moment.
I think.
So
Yeah, I think for real data, I think tomorrow maybe the bigger day, Blake, because we are going to get PMIs, we are going to get that PCE, etc. And
yeah.
into the weekend, we need to not only watch the data, but take into account what may happen always, weekend risk, etc.
Yeah, and let's not forget that as we were talking about earlier, here's crude. Like crude looks like it's just it's going to stop out anybody that's short. At least if anything, we're going to get that move today. I don't know how big of an explosion we're going to see here, but I think if we start trading above 66.50, we probably are going to trade quickly above 67 just to stop out anybody who's short. You know what I mean? Like how many people are throwing in the towel right now or here shortly? I'm sure everybody is. So anyway, K-Man, thank you so much for being here. I really appreciate you. And by the way, tomorrow Ryan's out for the
Yeah,
last couple of days because his kids are on half term. Is that what they call it? What do you guys call it over there?
yep.
Yeah, so he's on half term. He's keeping his boys busy. K-Man's going to be here with Stelios tomorrow, and also
And
Nick from Trading Analytics. He's going to join in,
I
and
think
so
Gregor is going
K-Man's
to
going
be
to be
there
running
as well.
face. What's that?
Gregor may be there as well. So it's
Yeah,
going
I
to
think
be
Gregor might join, and then I'll come right after PCE. I'll be jumping in just to say hello and seeing what the reaction was with you guys. And so K-Man, thank you so much for the flow show today.
no
Thanks for
problem.
handling everything. We really appreciate you.
Cheers, mate. I can hang around if you want.
Yeah,
Listening to Dale,
yeah.
me being an ex bank trader, so it's always going to be interesting.
It's been a while since we've had Dale on. So Dale Briscoe, welcome back to the show. Good to see you and good to hear from you, my friend.
Uh, Good afternoon or good morning.
Or good
Yeah,
afternoon. Good afternoon to you. I guess it's 1 o'clock now, right? Yeah. So
yeah,
it's
1:30. That's right.
yeah. So how you been? How's life been?
Life has been good in general. Performance-wise, great start to the year, but sideways for the last few weeks. And this comes back to what you said, I think, just a few minutes ago. Equity markets are very challenging at the moment. I think there was easy money to be made at the start of the year, but since then, I think it's been extremely tricky and is likely to stay extremely tricky for the foreseeable future. So I wish I had something more constructive to say in terms of brilliant ideas. I mean, I do have some ideas. I wouldn't say they're clear-cut home runs, but we're managing to get through this sort of volatile, tricky period at the moment. Okay, and just to clarify a few things, I think you mentioned that I run a fund of funds. That's not actually true.
Oh,
My background is I have a master's degree in engineering from Imperial College in London, which is the UK equivalent of MIT, and I think Stelios is also ex-Imperial, which is kind of how we sort of originally got introduced to each other. I'm a bit before Stelios. I'm in my 60s now, and I'm actually semi-retired. So after my degrees in engineering at Imperial, I went into the city as a trader and was a prop trader for some of the big investment banks, Lehman, Bankers Trust, UBS, and so on. And have traded pretty much everything over the years. From started out trading rates and FX, and then I moved into quant equity. Then I did a lot of commodity trading. And then in the 90s, I first got involved in hedge funds and have been sort of running hedge funds. I was a PM for some hedge funds. I was a CEO, CIO, COO of various hedge funds. And then I was also running a fund of hedge funds business back in the day. I'm talking about 20 years ago now, where we were allocating to hedge funds and private equity funds. But then about probably 10, 15 years ago, I sort of semi-retired and took a step back and set up my own business, which is an investment consulting business. And now I consult to, my biggest clients are Citadel and BlackRock. So as you may know, I started out my life in the financial markets at Lehman in the late 1980s, and my first mentor in the business was Rick Reeder, who was recently in line for a potential Fed chair position. Rick's a very, very good guy. So my history is long. I wouldn't say necessarily spectacular, but I've done a lot of different things. And yeah, so at the moment, for the last few years, I've been advising some of the biggest hedge funds on primarily their equity and long short trading, but I also do some global macro stuff as well. So I tend to take a longer term approach to the markets than perhaps some of your colleagues or clients. But I think some of the insights that we have can be quite useful in terms of strategic positioning.
it sure is, and it's been a pleasure to have you in our chat room the last few months. Dale, it's nice being able to see some of your insights in person. I'm going to give you the charts here in just 1 minute. I'm sure you got some charts you'd like to show, but I want to ask you a few questions before
Yeah,
we go there.
sure.
A few things stick out. Obviously, we talked a little bit earlier about the S&P and the frustration that we probably see from portfolio managers around the globe. How have you been managing it? I know you said the beginning of the year was easier, and then that's where the easy money has been made. It's been a little choppy since then. How are you making sense of everything that's happening? I mean, here we are, pegged to our highs. Yet the risks seem like they're mounting, in a very, very big fashion.
Yep.
Yet the markets are just kind of stuck. I mean, so how are you navigating that as a whole?
Yeah, that's a good question, and the honest answer is with difficulty. It's not been easy at all. It's been quite challenging. I think directionally, it's been extraordinarily hard to try and make money unless you are a dedicated range trader, and you're very disciplined in terms of selling the tops of the range and buying the bottoms of the range. I think you will have found it difficult to have made money in the last couple of months, is my guess, because clearly from the April lows of last year, it was kind of a moonshot straight up until, maybe Christmas time. But since then, it's been very much sideways and choppy. And to me, this, my nearly 40 years of experience now suggests to me that there is a top coming, whether it's in place or not. I don't know. And whether it's a long-term top, I doubt it very much. Over long periods of time, the stock market always goes up. So, you're on a hiding to nothing if you're trying to sell it. I mean, if you're going to short the market or short sectors of the market, the timing of it has to be almost perfect.
Right.
And you have to be in the trade for a relatively short time, because even if you are short and you're right, the bounce backs in bear markets are usually extraordinarily large and very, very nasty. So it's very hard to be sure. A lot of what we do is we run hedged books. So we run long, short, trades. So we take some of the market directionality out of it, which makes life a little bit less perilous, and it allows you to sleep at night a bit better. And also, you can extract value from the market even if it's trading sideways, because there are opportunities, obviously, in individual stocks or individual sectors.
Sure. One of the things that kind of sticks out in my mind, and the reason why this sticks out in my mind, and I haven't probed you about this, but you were, I've been so like, I mean, if anybody listens to the week ahead videos or these daily shows, I've been about as peak bearish crypto as I can imagine the last couple of months. I don't have any other words to really extrapolate how I feel about how bearish the crypto market I am. I recall this, and I never asked you about it, but something that sticks out in my head just because of my feelings on crypto right now. You were playing miners at one point, maybe a month or two ago. Let me ask you, how did you manage that? I haven't looked, and I don't even know where to even start. I mean, there's probably mining stocks, but how do you feel about the crypto market, because it's been so bleh,
Um, I was long of Bitcoin mining stocks and precious metal mining stocks and uranium mining stocks and a
Okay,
whole bunch of other mining type stuff
got it.
last year, and we made a shed load of money. In fact, last year was probably one of our best years ever. We got out, or I got out of pretty much all of the Bitcoin mining stocks towards sometime either late Q3 or sometime in Q4 last year. Um, and that was somewhat technically based, but also somewhat fundamentally based in terms of the so-called quote 4-year Bitcoin cycle, right? So there was a timing peak late last year, the 4-year cycle for Bitcoin, suggesting that we were probably going into a 12 to 18-month period of Bitcoin down effectively. And whether you believe in the fundamentals or not of Bitcoin, and for a long period of time, I was very much in the doubter camp, and I treat Bitcoin like any other risk asset. It's a risk asset. It's as simple as that, and that's how I look at it. So Bitcoin was the first tell in terms of the 4-year cycle late last year, when it's had its first big sell-off and subsequently continued to go lower. The precious metals continued to go higher because there was obviously some rotation out of some of the risk chasing money into the precious metals, and the spike that we had in sort of late January, early February. Um, And you could argue that since the washout in silver, especially, but silver and gold and so on, some of that risk chasing money again has migrated over now to what is left, which is the stock market, which is what is keeping it probably from having a bit of a nosedive. So I agree with you. I think there's still some more downside on Bitcoin, probably to the 50 to 60,000 range. And that's what I'm looking for in terms of a longer term sort of fundamental play back on the miners. But interestingly, if you look at some of the sectors, and I'm happy to share some charts with you.
Yeah, please do. Yeah, please do.
Okay, let me
pass that over to you.
Okay, let me see if I can grab it.
By the way, great exits on all those miners. I mean, a lot of times you might be a little early, but early sometimes can be right as well, especially on exits, right?
Yeah, I think in your chat room, I came out one day and I basically said I'm getting out of gold and silver and all my mining stocks, which was in hindsight, it was about a week to 10 days too early, and I missed the blow off last piece. But there again, I wasn't in it and didn't suffer the big washout that happened. So I'm quite pleased about that, even though I sort of missed probably 10%. It's okay. Anyway, can you see my screen?
We can. Yeah, average hourly earnings.
Yeah. So what
Yes.
I'm going to do, Blake, is I'm going to just run through a bit of quick econ stuff. There's a lot of charts I want to show you, but they'll probably be very briefly. So, okay, so let's just look at the economics, right? So this is real GDP and the reason why the Fed have been cutting rates. But as we can all probably acknowledge, there's really nothing wrong with GDP, right? It's fine. Average hourly earnings headed upwards. So nothing wrong there. Leading indicators, nothing wrong there, right? This is all pointing to a robust economy. This is the unemployment rate. And the reason why the Fed is sort of gagging to cut interest rates again. But if you look at going back 50 odd years at past sort of blips in unemployment, the cycle that we've had over the last 2 or 3 years in terms of the gradual rise in unemployment is not at all like what we've had before. So to get worried and concerned about something very dramatic happening in the labor market is complete hogwash. The only sort of things that you might want to be thinking about are, the consumer. So retail sales look like they're having a little bit of a dip. If you look at the University of Michigan consumer sentiment, that's kind of at its lows for the last, many years. And as the US consumer is a big part of the driver of the US economy, then that is something to be thinking about. But if you look at, inflation expectations, they're still elevated. You look at the CPI, okay, we had that massive blip after 2020, and it was in 2020 after COVID that I basically said, 5-6 years ago, we are in a generational bull market for inflation, and I don't see any change to that short term. We are not going back to the low levels of inflation that we had for most of the thousands. I think we are inevitably headed higher, and that colors my perception of wanting to be in assets which are inflation hedges, and why I think most things on a nominal basis will go up over coming years. On an inflation-adjusted basis, they may not, but most things will go up on a nominal basis. US money supply, that's not going anywhere except probably higher. So where does that leave us? I think Stelios and I have a debate about yields, but my view on yields is that we will ultimately go higher, and this is the 10-year. And if I look at my targets for the 10-year, it's probably to around 6.5%. And people say, oh, we can't have 6% rates. Well, we can. And, historically, when we've had big bouts of inflation in the past, we have had, very high rates. I remember when I first started trading at Lehman back in the 80s, we had double-digit short rates. And people just can't get their heads around that. But we've been there before, and there's no reason why we can't be there again. I think, however, what's more likely is that we get curve steepening, and that's one of the trades that we've had on from a macro perspective is, long the short and short the long end. And that continues to work well. So we think that's still got a little bit more room to run. If we look at 10 years against German 10 years, which is one of the main drivers for, FX and the euro dollar, obviously. I think we might be basing out here. And if that's the case, then we could be in for a period of stronger dollar. We're not there yet. I still need a few more triggers for me to want to do this trade longer term. But we're getting close, I think. And that comes back to the dollar index, and you can see my bull bear line there. Yeah, this sort of pullback in the dollar last year was a trade that we had on and worked very well, and that has worked fine. But where do we go from here? The honest answer is I think we're still a little bit up in the air. If you look back over a very long period of time, the dollar has been in an uptrend going back 15 odd years. And it may be that last year was just a pause in that uptrend. I know that a lot of people bearish the dollar, and we were when Trump came into his presidency again. But I don't think the dollar is going to stay weak forever, especially not if you get some weakness in risk assets, which looks like it might be possible, right?
Right.
But this is coming on to what you were saying earlier. The S&P. We've effectively gone sideways for. This is like 3 months now. So it's extremely hard to trade from a directional basis and make money. We are at the top of a channel, and I think there are reasons why you need to be cautious right now. I think it's extraordinarily hard to try and short it. But I think there will be an opportunity at some point to do that. But right now it's just chopping, and I think we're waiting for a trigger to try and get short. Because if you look at some of the underlyings, if we say that there's a lot going on in the stock market right now. Okay, people say, oh, it's basically going sideways and it's choppy. Yeah, that's right, but there is a lot going on underneath the hood. So if you look at things like semiconductors, I mean, I think people are bearish on some parts of the tech sector right now, but semiconductors look absolutely fine. If you look at the momentum factor ETF, there's still a lot of momentum stocks that are doing well. And until these things start breaking down, it's hard for the S&P to really start cratering. The equal weighted S&P, again, is it toppy? Yeah, it looks toppy, but you can't sell it. You can't short it at the moment.
Right, just because it looks like it's still trending higher. I mean, you can't,
You can't, yeah, you can't go against the trend. The trend is your friend, right?
Right.
What has been going on, quite interestingly, is there's been quite a bit of rotation, right? And
Yeah.
you can see that. So, what sorts of rotations? Well, several. One is large tech to smaller cap sort of Russell type stocks. So out of mags into Russell type stocks. You can see that quite clearly from this chart. You can also see it on the growth and value spectrum. So this is Russell growth over Russell value, and that's obviously had a bit of a hit in the last few months. So
Dale, can I stop and ask you a question here about rotation? You're seeing a lot of rotation out of tech, obviously, but you're talking about U.S. markets to U.S. markets. How are you feeling about like U.S. markets to international markets? I mean, we just had your FTSE at all-time highs.
Yeah,
right?
no, yeah, and I think I mentioned that,
which is kind of crazy. I mean, but it's quietly ripping into new highs. I know we pointed it out in our room a couple of days ago. I'm like, hey, don't forget the FTSE's at new all-time highs here. But you're seeing rotation away from the U.S. into other markets, or are you? And do you think that trend's going to persist? That's the question. Really.
Yes, you are for sure. And one of the reasons why there's a couple of reasons why the FTSE has been doing well relative to other markets, and it's because the UK main market is considered to be defensive in nature, and that's for a couple of reasons. One is the types of stocks that constitute the index. So you get a lot of pharma stocks, metal mining stocks. Historically, London has been the home of big mining companies. And there are big sort of dividend plays as well. So you think of the likes of Glaxo or Unilever. These are what we call defensive type stocks with big dividends. And in a world of nervousness, if you like, in equity investing, where people stop thinking about chasing something that's going up just because it's going up, because there's no fundamentals behind it, doesn't pay a dividend, and you're basically just chasing the price action. When there is nervousness about that, there is a rotation into defensive type sectors, defensive type names, and defensive type markets. And the UK is one of those, despite the fact that you could argue that the fundamentals of the UK economy are not that great, right? I mean,
Yeah.
you can ask Ryan about that. It's not a great economic scenario, but the stocks that make up the index are defensive in nature, and that's what's attracting people to those stocks in the UK. So just pressing on. So this is coming back. This is the Russell Value Index. So you can see there's nothing bearish about that. So people are investing in value type names as opposed to growth type names, which you can see they've come off their peaks from sort of late last year, whenever that was, sort of October, November time. So it's a confused picture. Right? So this is the percentage of stocks above the 200-day moving average, and anything above 50 is generally perceived to be bullish. So we are in a bullish environment still, I think. Although that could easily change in the space of a few weeks. If I look at this is TLT against junk bonds, and at the moment this is indicating that we could be preparing for some risk off. I want to see a break of that trend line and a break of sort of the 93, 94 level, and we're not quite there yet. You do have a very, very big divergence in the RSI going back for 2 or 3 years. So at some point that is going to flip, but I haven't seen the driver yet. And the other thing that I point out is the VIX. The VIX, I'm always telling people, if you look back over very long periods of time, anytime the VIX gets to 50, you basically just want to close your eyes and buy for the long term, and just close your books, close your books, and come back in a year. We probably
when it gets above 50, you want to get long risk, and I get what you're saying. Yeah. Okay.
And so that's kind of what I wait for from a long-term perspective in terms of going large in size and in risk assets. We're probably due for one of those, and VIX has been holding its lows for the last couple of years. We've had a couple of spikes already, which have enabled nice entries. In the middle of 2024, in the March April period of last year, we're probably due another one. And you'll probably get a decent warning if it sort of trips 25, 27. I think you'll sort of get a big rush to risk off, and that will give you the opportunity then to buy, for your SIPs or your pensions or whatever it is you invest in longer term. But we're not there yet. But just coming back to some of the rotations. So the Mag 7 have obviously been a driver of the index going up for many, many years, and certainly since the April lows of last year, they were the big drivers. But there has been some bloomers come off the flower. It doesn't mean to say that we're necessarily going lower forever in the Mag 7. I just think that people are now looking elsewhere, and one of the reasons for that is the software and services sector in technology, with the whole rush to AI and AI and quantum of the new darlings, thinking that software companies are not going to be able to compete because AI is going to put them out of business. Not sure that's right. Certainly not for all the software stocks, maybe for some of them. But these companies have been around for a long time. I'm talking about the Microsofts. They're not going to go out of business overnight, and they do have sustainable business models.
So in other words, Dale says stay sassy. That's a bad joke. That's a bad joke. Sorry.
I saw what you did with that. Very good. Yeah, sassy with the double A. Just coming back to the mag. So, this is XLC, the communication sector ETF. This looks like it's acting a little bit soft right now, and that's sort of Meta and Google. If you look at XLY, which is the consumer discretionary ETF, that's a big chunk of Amazon and Tesla. That's not looking great. So where have we been playing to try and avoid some of this? Well, surprisingly, in the energy sector, energy has been a little bit defensive in nature, given what's going on in the world, and Trump sending his battle carriers to the Middle East. That may or may not kick off. I'm always wary about calling wars. Inevitably, they usually don't happen. People see the sense, and it doesn't happen. So this could all be
Sure.
a big run up, and may just be a fake out, but it continues to have a little bit of legs at the moment. Industrials have, because I said at the beginning, the economy is actually okay. There's nothing wrong with the economy, as I can see it at the moment. As there may be some exogenous shock that we don't see coming, but like a COVID, but I don't see it at the moment. Now, this is interesting. So this is consumer staples. So this is the defensive type stocks like, Procter and Gamble, Coke, Walmart, Costco, those sorts of stocks. They've had a big run up in recent weeks, right? Because people are getting nervous.
Yeah, I was going to say, so this is one of those, scratch your head, be a little careful type of moments, right?
Yeah. But you could argue now that they've had their pop, they've almost reached the measured move out of this little channel. And it could be that people start coming back into, riskier names. I don't know. We've made some money, and we've now taken some money off the table in these stocks. Same with healthcare. Healthcare is another defensive sector. It had a decent run up sort of in the latter part of last year, but it's now at its sort of all-time highs, resistance levels. So talking about Johnson & Johnson, Lilly, Merck, AbbVie, those sorts of stocks. Again, so you could argue that the money has already been made, the easy money's been made in those stocks. So which stocks do we not like? Well, obviously we're talking about XLC. That looks to me like, from an Elliott wave perspective, you could argue that it's completed a very nice third wave and is now due a fourth wave pullback, which could be, a 10 to 15% pullback. So we're a little bit cautious on those types of names. The Apple, Microsoft, Avgos, those sorts of stocks, Oracles. I think we're at an interesting juncture. It could go either way. So we're not really in that space right now. I think it's too hard to call. You could either get, a 10 to 15% pullback, or you could get another 10% rip. And I don't want to be on the wrong side of that. Going back to what we said about retail sales being the one weak spot in sort of the macroeconomic picture, I think we could be at an interesting point for some retail stocks. I haven't found any that I want to go short of yet, but we'll be looking closely in the next few weeks and quarters. XLF.
I was gonna interrupt you just really quick. I know K-Man is here with us, and I don't know what his timeline looks like, but I wanted to see K-Man. Dale's been covering a lot of ground here. Did you have any comments for Dale?
Not specifically in regarding markets or what the views are on markets, but hi Dale. I mean, okay. K1 is my scene name. I've been working for like what, nearly 36 years in banks, mainly as a spot FX market maker. So we were not sitting on the same desk, but there may have been some overlapping. And by the way, you're in your 60s. I am too. It's the new 40s. So we are going to be very,
I
very
stopped
cool.
counting at 40.
Very, very, very cool with that. No, I have a question in general because you have been working for a lot of different organizations, hedge funds, asset managers, etc.
Yeah.
And completely out of the context that we are talking about now, but it may be of interest for people, younger people who have aspirations of going and managing money, etc. And I just want to have a 1 minute answer, whether it's a hoax or whether it's really something that the asset managers or money managers are looking at when they hire people, and that's the Sharpe ratio. Because the reason why I'm asking is that I think the Sharpe ratio can be managed or looked at when you have already a book and etc. But it has such a big jump from one instrument to another. Like for instance, if you take long-term positions on equities or bonds, you can actually, I'm not going to say force your Sharpe ratio higher, but if you are an FX trader, getting a Sharpe ratio which looks really great for somebody to hire a trader in an asset manager or hedge fund, it's really hard, right? And I don't know what you think about that. Is it really important, or are we just looking at yearly, quarterly, half-yearly returns in percentage wise?
Um, that's a very good question, and the answer is unfortunately not a 1 minute answer.
Okay.
It really depends on the type of organization that you're looking at and how they perceive risk. So, for instance, if you want to go to Millennium or Citadel or any of these big hedge fund pod shops, you generally speaking need to have a high Sharpe ratio, and more importantly, you need to have very low drawdowns. And the reason for that is they typically leverage up themselves, so they don't want people having huge drawdowns because that's a big hit to them. So they'd rather have a lot of pods, a lot of PMs or traders that are managing money across different asset classes and across different strategies that are generally not correlated with each other so that they can leverage up their book. And so they want high Sharpe, low drawdown, low vol is what they look for. If you talk about individual hedge funds that are doing I don't know, a very specific strategy, then it will really depend on what that strategy is as to what your Sharpe ratio should be and is appropriate. So a long short equity guy, for instance, is unlikely to have a Sharpe ratio much higher than 1. Whereas if you look at a market neutral long short equity guy, Sharpe ratio could be significantly higher, although his absolute return is going to be substantially lower just because of the way that they manage their books. And I do both of those. So, for instance, for one Citadel portfolio, we run an unconstrained long short, meaning that it's dollar neutral but not beta neutral. And for that, over the last 3 years, and I'm ranked probably number 2 or number 3 in the world over that period of time, we've returned 50% per annum with a Sharpe of close to 2, which is very, very high for that sort of strategy. Whereas there's another book that I run for Citadel, which is a market neutral, beta neutral book, which is only annualizing at about 12%, but it's much higher Sharpe, right? Because the drawdowns are less. So it really depends on what you're doing. But obviously, the shorter term timeframes that you trade under, generally speaking, the higher the Sharpe that you will have. But long-term capital that's allocating to those sorts of strategies, they generally don't want you to be turning over the book every day. So they want you to have positions. They believe that the alpha comes from, longer term ideas, not from day trading. It's very hard to convince, investors to put money into a shorter term strategy.
Yeah. All right. Okay, but as you say, it's not an easy one to answer in a minute's time. Because I'm looking at my own, but it may be a wrong calculation, but I have very small drawdowns, but still my Sharpe ratio remains quite low. And but I'm doing mostly FX, and I think it might be something typical for FX as well.
It is. I think it is more. Well, you have to be good at what you do, right? Otherwise, it's not typical. If you're good, then you will have good numbers. And I would say with a strategy like yours, trading FX, then you would be a good fit inside of one of the pod shops like Millennium, especially if you've got a low drawdown.
Yeah, and I'm going to jump in here really quick.
Thanks,
Just knowing what like companies that I've recently dealt with the Gelber Group out of New York, they really do look at your Sharpe ratio. But as an FX trader specialized, they do, like Dale said, take certain things into consideration. So very good question, K-Man. Hey, Dale, we are actually running kind of
Yeah.
into our daily or morning edge here in just a few minutes. Sorry, it's already been a long morning. But I first of all, I love all your views. I know we kind of jumped in as you were still going over things. Real quick before we wrap things up, I wanted to ask you just what your overall view of precious metals are based on the recent run that we've had.
Yeah. So I think we are due more of a pullback in gold and silver and precious metals. I think that will provide a buying opportunity longer term. And what I was going to say about that is, if you think energy is good relative to other stuff, so this is energy relative to healthcare, this is energy relative to retail sector. So energy looks generally, and this is energy relative to the S&P, right? And this is my view on that. If you like energy, then when you look at GDX against energy, I still think this is positive, right? GDX versus XLE still to me looks like that's still bullish. So if you like energy, you should like precious metals and miners, right? And so yeah, the view on GDX, for instance, is that this red line here, about 144, we have now broken above that, and we're sort of dancing around it. If we get a decisive break above that in the next, few months, you could easily see, another 50% upside in GDX relative to SPY over the next, year or two. So I think longer term, yeah, any pullbacks should provide decent buying opportunities. Same goes with metal mining ETF, which is more of the sort of the standard miners, if you like, the Alcoas and so on, FCX. And the other sector that is kind of interesting, again, sort of from a sort of mining perspective, if you like, is some of the uranium stocks. The uranium miners still have a very strong view and outlook on that. And then just to finish off on Bitcoin, maybe. This is the view on Bitcoin. Still think we could see sort of that 50 to 60K area. But interestingly, the Bitcoin miners are kind of holding in. So I think longer term, I still think it's a good trade, and you could easily double your money on some of these Bitcoin mining stocks in the coming years. I think you have to pick your moment, because we still may have some more downside. And if we get below that red line there, then maybe all bets are off. But I still think anything that's involved in mining an asset or something that is going to go up in value because of inflation is probably something that you want to own.
Yeah. All right. Well, I mean, hey, I think there's all sorts of opportunity in crypto once we reach those levels. Whether you're looking at crypto proper, like a Bitcoin or Ethereum vehicle, or maybe even in the miners, as Dale's pointed out. Dale, it's been such a great pleasure to have you here. Now that you're in our chat room, I will definitely be bringing you on more often. It's like I said, it's wonderful to have you here. We haven't had you on in a few months, and I hope to have you on more regularly now.
It's my pleasure, Blake, because I think I've said to you many times before, I really admire what you and Kay and Stelios and Steve and Ryan and everybody at Forex Analytics are doing for the wider community in terms of younger, sort of less experienced people coming into the market. So I think that's a great service that you're doing. And as an old hand and someone that's sort of generous by nature, I'm very happy to come on and share my experience for good or for
Uh,
bad.
Well, fantastic. It's wonderful to have you here, Dale. And I want to thank you so much. So, guys, I think this is one of those interviews you should probably not only watch again, but maybe watch it again and again. So, Dale, thank you so much for blessing us today with your presence. I do appreciate it, and I'll be circling back with you, obviously, in the room, but I'll be circling back with you to nail down another time as we get into the springtime, as weather improves in your neck of the woods. How about that?
That'll be great because it's done nothing but rain for the last 3 months.
All right. Well, stay warm, stay dry. K-Man, thank you so much for everything, buddy.
Cheers, guys. Thanks, Dale.
And make sure you
You're
guys are
welcome.
tuned in tomorrow for the F.A.C.E show with K-Man, Grega, Nick, and then also Stelios. So the four of them will be broadcasting with you guys tomorrow. So thank you, Dale. Thank you, K-Man. And thanks to all of our viewers. I'll see a lot of you on the Morning Edge in about 1 minute. So thanks, everyone.
Thanks, Blake. Thanks, Kate.
Thanks, Dale.